What has surprised you most about the current real estate market?
For the last 15, probably 25 years, we've been in a financial market. Now we're in an operator's market, which reminds me of how I started in this business 30 years ago. So what surprised me is Back to the Future.
What a treat today. I want to welcome everybody to our Accounting Capital podcast. As you know, I'm Robert Brunswick, chairman of Buchanan Street Partners, and I could not be more excited today than to have a special guest, Spencer Levy from CBRE, joining us. He's officially known as the Chief Strategist and Economic Advisor for CBRE, which is the largest commercial real estate services firm in the world. So that's saying something. His bio is notable and distinguished. He's regularly quoted on CNBC, Bloomberg, Fox. He has his own CBRE podcast entitled The Weekly Take. So we'll hear more about that. Amazingly, his experiences range from being a lawyer, investment banker, capital markets expert, and senior researcher. So I've no doubt that you're going to thoroughly enjoy Spencer's rich and entertaining content. I look forward to getting started. So you're a busy guy. Can't thank you enough for taking the time to join us. Maybe as a kickoff today, Spencer, aside from what we might read in your bio, help us get to know Spencer Levy. How did you end up being the senior global strategist for the largest commercial real estate firm in the world?
Well, every journey starts with a single step, but my journey took a little bit longer than most, Robert, because as you noted in my background, I'm a lawyer, I'm a banker, a research leader, capital markets leader, but I'm going to go with one word that got me to where I am today. And that word is courage. It's the most important word in the English language as far as I'm concerned. And I had a big moment about 10, 12 years ago. I had the opportunity to give a speech in Denver in front of 3,500 people, including all senior management, our board of directors. And Robert, I don't want to belittle any economists out there or other lecturers, but you've been to plenty of economic speeches that you kind of wanted to leave. And so have I. And I was like, well, there is a better way, a lot better. And I'm going to go for it. And I said to myself on that show, I'm either going to get promoted after this speech or I'm getting fired because I'm doing this my way. And my way was during an economics presentation in front of 3,500 people, I had a costume change. I walked into Times Square before the speech and I did fake interviews with people on funny topics. I called out senior executives from my company from the stage during the speech. I then had a poignant ending, and it was maybe the first, maybe the last economics lecture in the history of economics that got a standing ovation. And I got a note right after that from a very senior executive at my company. He said, "Spence, I'm not quite sure what you do for a living around here, but you're going to do that." And here we are. One moment of courage, a lifetime of success.
Well, it's a great perspective to provide to our varied audience listeners. And I think of CBRE and I think of the seriousness of the job they perform for their myriad of clients worldwide. So maybe backstop what you just said as to the entry point and help us understand, the day-to-day job description. Because a researcher providing advice that people make very serious fiduciary and financial investment decisions based upon is a serious job responsibility. So color a little bit about those responsibilities.
In our industry, I would say that most people do one thing on one side of the business. I do a lot of things all over the business, but really I cover both sides of the house. And the house really is two sides. One is the investor side, one is the occupier side. And on one day, I will speak to the largest investor in the world about what I see in the market and what I think they should consider doing. On the very next day, I'll speak to the largest occupier in the world and say, this is what I see, this is what I think you should be doing. These are the trends. And then when I speak to both, I marry the two. And so it's a very unique perspective in that very few people speak to both sides of the house on a daily basis. And I do this both one-on-one. As I mentioned, I'm heading to New York tomorrow for a big meeting tomorrow afternoon with a big investor, or I do it from the big stage. And the big stage is I will do that in front of either industry organizations. I'll do it for offsites for big private equity firms. I'll do it for offsites for big occupiers to share the message from the stage. But I really don't do the stage work for the stage work, even though I'm not going to hide the ball. I love doing it. I love doing it because of the opportunities it creates. It creates the opportunity for me to get the one-on-one meetings with the companies, to talk to them, really talk turkey about strategy, because the stage is really the appetizer to digging deeper into that strategy that can help them. So day to day, it's meeting with the largest owners and occupiers, either one-on-one on the big stage. There's the podcast. There is, believe it or not, a bigger part of my job becomes social media presence. I'm a big user of LinkedIn. And when I say big user, I post twice a week. I'm about to post today, as a matter of fact, on my trip last week to California, and I'm entitling it California Dreamin', because what I was thinking about was, in addition to all of my great business relationships, including yours, Robert, in Southern California, some of the best times of my life have been in California. And a lot of people get down on California. I'm not that guy. I am big on it, not just from a business perspective, but from a personal perspective. They call it the sunshine tax for a reason. It is a great place to be. And so in any event, that gives you kind of a general description of my life.
Beautifully said. I know that sunshine tax, and we also call it the country club tax to enjoy this beautiful state. But we'll talk a little bit more about that. So as I think about the gathering of your research and the sanctioning of that, the sign off of that, is this just Spencer doing what Spencer does, and you gather the information, and CBRE some might agree with you, some might not agree with you, but you're empowered to do it as you see fit to provide this advice to owners and occupiers?
I start from a ground, and if you saw the way I'm preparing for this meeting I have tomorrow in New York, it's Exhibit A. I probably have reached out to 20 different researchers in different areas of expertise: multifamily, industrial, capital markets, senior leadership. And I asked them the same basic question: what's going on? I want to know the facts of exactly what's going on the ground. What does our forecast look like? And then, I put on top of that my own opinion. And I don't hide my opinion, because I think it's important to have a stable baseline of the facts shouldn't change. I mean, there's some famous politician said, you're entitled to your own opinion. You are not entitled to your own facts. And so I try to make sure that I have a great baseline of facts, great baseline of what's happening, and then I'll input my opinion. And sometimes it's counter to others. But now I'm respectful of the House view. I'm respectful of others' views. But there are places you can differ. So I'll give you a couple of examples, one macro, one micro. So here's a macro example. So over the last several months, growth expectations in the U.S. economy have weakened. They've weakened at CBRE's house view, Wall Street's house view, the Fed, you name it, they've weakened. I differed. And the reason why I differed was I think people overreacted to a lot of the public policy noise that was in the marketplace related to tariffs and otherwise. Now, neither one of us knows where this is going to go, but nevertheless, the news so far has panned out in my direction. I'll give you another one, a micro one. Going back to my California dreaming, the sunshine tax, I think I said this in your office, Robert, I'm very bullish on San Francisco, very bullish on it. And I have been for a while, in large part because, number one, most people aren't, and I like to go where people aren't. Number two, if you take a look at San Francisco on a historic basis, you'll see that it is always one of the most volatile markets. And now that it's down, it's a great time to enter. And guess what? What did I get yesterday? I got the new office forecast. And what is our number one rent growth forecast market? San Francisco. And so I'm not always right. Listen, I called it wrong in a few places. I once said inflation is not only going to be lower for longer, it's going to be lower forever. That didn't work out. But, I also will tell you where I got it wrong and why. And that's, I think, what separates me in certain ways from others, in that I'm not just going to parrot a view. I'm going to give you the view, and then I'm going to layer my opinion on top of it and tell you why. Because during COVID, when I was helping lead research, I told our research team, you are no longer in the research department. You are in the Oracle department. People don't want to know what you know. They want to know what you think about what you know. And that's, I think, a really good lesson For most people out there, don't be afraid to give your opinion if it's well thought out and grounded in fact.
I love that, and I made note. That's a great takeaway for our audience. So, CBRE, you're going to correct me or provide me with the answer here. Is a significant client in their own right as a fiduciary and an investment manager for lots of clients. So, can you help maybe differentiate the third party work you might do from the CBRE as a principal and discretionary investment manager?
Sure. So, CBRE investment management, there's two sides to the house. There's the advisory side, which, hello, that's where I am. And then we have the other side, which is the capital side, CBRE investment management, and a subsidiary of that or a group. Part of that is the Trammell Crow Companies, which is the largest builder in the United States. I haven't spoken to them since this morning. And when I spoke to them this morning, I actually did something that's a little bit, say, did you really do that? Yeah. I did public speaking training. I train clients on how to speak in public because I think so often what our clients are excellent at is mathematical, factual, Excel, PowerPoint, Argus, the facts. I'm like, well, that's great, but that's table stakes. You then need to communicate that in a way that is persuasive. And I think that's the last mile that, well, I try to help them with, and I've done it for many, many other clients. But back to your question, two sides of our house, advisory and investment management, which is the investment management side is a global firm, well over $100 billion of assets under management in the US, Asia, and Europe. And they are a fiduciary for some of the largest pension funds, endowments, and high net worth groups in the world, investing on a principal basis, the real estate where I'm advising. I advise CBRE. I advise other investment managers as well what to buy, where, and when.
Perfect setup. And you'll let me know how comfortable you are with providing this information. We have a broad base of real estate owners, listeners, investors today. So I think this will be valuable for them. We'd love to get a sense for some of your advice and that you're providing clients today about the prognosis of kind of real estate broadly today. You know, when I got into business, Spence, there was retail, office, industrial, multi, 4 food groups. Today, there's 25 food groups, much larger asset class, much more opportunity for capital to flow to it, depending on risk profile and appetite for maybe a prognosis of where opportunity exists. So share with us where you see what your prognosis might talk about in regards to the opportunities that might be available in the market today.
So let's first do a little history lesson here on how the market has changed over the last 30 years. So 30 years ago when I got into this business, real estate was much more of a slow and steady wins the race. It was very much a high net worth business. It was very much an operator's business. And then there was a massive change in our business in around 2000. In 2000, the massive change in our business was the influx of significant institutional capital into the sector. And it went from, call it 3 or 4% before 2000. Now it's up to about 13, 14% today. And that massive change precipitated this. It precipitated a change in the way people looked at real estate from an operating asset to a financial asset. And that's, now there's obviously shades of gray in between there. I'm going to go there in just a moment. But that fundamental shift meant that if you go to, say, the 2012 to 2022 period, about 75% of all gains in real estate were due to cap rate compression. Basically, everybody was a genius when cap rates are going down. But prior to 2000, it was really an operator's business. It was people who were able to run these assets better. Even the big 4, as you just mentioned, Robert, were more operationally intensive because you were getting a higher percentage of your return from income versus cap rate compression, operationally intensive. Okay, fast forward to today. What's the big change that's happening right now? Well, it's back to the future. In the next 5 years, because of inflation, because interest rates have stayed high, and other reasons which I'll go into, we're going to become an operator's business once again. Because 3 or 5 years from now, you're not going to get bailed out by materially lower cap rates. The only way you're going to be able to get whatever the targeted returns are for your fund is to operate better. And you can operate better on both the top line by growing revenues or by better managing the bottom line. And both of them are going to be important. And which brings me to your point. The big four asset classes, which were less operationally intensive, are now going to be more operationally intensive if you're going to be able to get those kind of returns. So yes, you're correct. If you go to the alternative, we used to call them alternative asset classes, and these are things such as senior housing, single family rental, data centers, student housing. We can go into a whole litany of medical office, healthcare real estate. All this stuff is alternative forms of real estate that are more operationally intensive because of the nature of their use. That same operational intensity, some of it is going to now go into the big four if you're going to succeed. So on the top line, you want to be more, and I hate to use this word because it sounds soft, but it's the word you need to think about. It's experience based, because people that are in the best office buildings today in Los Angeles, which is a market that a lot of people are pretty down on, and let's face it, the Bunker Hill section is really soft. In Century City, it's doing extremely well. Why? It's doing extremely well because they have great live, work, play, great experience based. You have submarkets within San Francisco, Jackson Square, almost fully leased. Experience based. I can go into every market in the country and give you submarkets like that. And then you say, well, does that apply to industrial, multifamily? Does it apply to retail? Absolutely applies, because people are, what I think is happening, Robert, I think the size of the institutionally investable marketplace is actually shrinking. And I think you saw that firsthand in office, where there's a percentage of it that has to go into non-institutional hands to convert it. But as it shrinks, the best institutional stuff is going to get more valuable as people put not just more capital, but more OPEX, not just CAPEX into it, to be able to grow the top line. But the bottom line is, of course, equally important. And there are two major issues there that people need to manage. One of them is labor. And if you have operationally intensive real estate like senior housing or hotels, it's a very difficult issue to manage. But then property and casualty insurance. Folks, I don't want to bring up a very, very serious issue, which is the terrible fires that just went down in Los Angeles, the terrible floods that just went down in Texas. But these things, combined with the storms, the hurricanes that have hit the Carolinas and Florida, are materially upending the property and casualty insurance market. It's becoming a significant piece of your NOI increase or decrease. So much so that I would say about a third of my multifamily investors now have a captive insurance company within them. So this is a long, fancy way of saying all real estate is becoming operational. The operators are going to win, and the big four asset classes are going to learn from these alternative asset classes what good operations look like.
Great summary and a lot to unpack there as I think about your background, and you have a capital markets expertise, and you'll correct me, but I'm going to say the average 10-year treasury over 30 years has been in the low fours. Oh my gosh, it's 4.3 today. So that tells me that the days of the financial engineer, the day of the accretive financing, making a deal work or not, is really now you're going to be subordinated to the operator that you're alluding to and running the real estate properly and creating value in that fashion. So I'm kind of glad you hit that. How do you view capital markets and pricing? And when somebody says, Spence, should I wait another year for these interest rates to tick down before I put this financing to bed? Your reaction is?
This is why we started our conversation of everything is based on facts. My opinions may be wrong, but they're based on facts. And I watch the facts carefully. And so 2 points about what you just said, Robert. One about the 10-year treasury being in the mid fours historically. Okay. That matters, but there's one thing that matters more in the short term. In the short term, what matters more is the relative value or the relative cost of the 10-year and the short end of the curve. Because the 10-year might be 4.4% today, which is about what it is, but it was 4 years ago. And a lot of people bought at that period of time. And so while the era of financial engineering may be over, there's some people who still have an overhang. And unfortunately, a lot of them are in multifamily and industrial when they bought at the peak. So there's still some issues that have to be worked out because of the rapid change in the 10-year, the rapid change in the short end of the curve. That's the bad news. So there will still be some financial engineering related to workouts, preferred equity, other forms of some kind of rescue capital. But here's where the facts matter. Facts always matter, but here's where the facts matter to this answer. So I was of the opinion that the market was going to be slow and steady as people readjust to the higher interest rate environment. Well, guess what? People have now readjusted. And so we're now seeing an uptick in sales. We're seeing an uptick in debt and structured finance. And I might add, we're seeing positive surprises in fundamentals. Now, a lot of the reason why we saw softness in industrial in the last 18 months was due to overbuilding. Well, guess what? That old supply and demand thing matters. What haven't we seen a lot of in the last 18 months? Building. And because of that, the market is now adjusted in industrial, and we are now much more optimistic on industrial outlook than we were as recently as 3 weeks ago. And I'm telling you, this is from a guy who looks at the numbers every day. Multifamily, same thing. When did I get my multifamily numbers? This morning. And when I looked at the numbers this morning, they may be more optimistic there as well. Now, are there still some overhang markets? Yeah. And these are markets that you know, like Austin, Texas, where there was overbuilding. But nevertheless, the long-term prospects of Austin and Phoenix and some of the other markets that might have oversupply are fantastic. And they're so good that I'm encouraging people, here it is, doggone it, I'm going to say it, build now. Huh? How could you build now in a soft market? Because 3 years from now, you're the only person that built. And in every down market that we've studied from a research perspective, the best time to build is when nobody else is.
Sure. Well, interesting. Our company, as you know, does a bit of lending, and we are an active construction lender. And it's been an interesting space when we look at the opportunities we're being presented that we would never have otherwise seen. So your answer and your prior comments kind of maybe a prelude to what I'm going to ask you next. And with all your prognosis that you make, and you're going to be wrong here and there, but I think your track record is quite impressive. What has surprised you most about the real estate industry as you think about the market that we now have upon us? Is there any shockers that you're kind of scratching your head at and that would be interesting to hear about?
I'm going to give you a complete non sequitur anecdote, and then I'm going to answer your question. So, one of the things I encourage people to do when I give lectures is have a hobby that has nothing to do with your business. And I don't care if you like bike riding, which I know you do, Robert. I don't care if you like movies. I personally like horse racing. That's what I do. I was just mentioning I was just down at Del Mar. I went there for 2 days, and it were 2 great days. Okay. I didn't win any money, but I had a good time. Okay, let's be real. But why do I say dig deep into something? Because if you're really good at something, it's going to help you at everything because it changes the way you think. And so the reason I got into horse racing the reason I got into horse racing was a funny reason, because remember during COVID, there was no professional sports on TV for some period of time. You know what was on TV? Horse racing. I'm like, what is this? I'd never watched a race in my life. But I said, there's something about this. And it wasn't the race. It wasn't the gambling. It was the statistics. And this is where the research mind comes in. And then what really hooked me on it was I discovered there were hundreds of PhD level articles written on the psychology of betting. And I got to read some of these. And I did. And you know what it did? It made me a better real estate analyst. Because I'll just give you one example. I can give you 50 on the psychology of betting. The favorite is always mathematically overbet, and the underdog is always mathematically underbet. Why? Because people have a bias towards winning even if they lose money. It's fact. I mean, I guess as fact as a PhD level article could be. And so back to where we were a moment ago, I think that what has surprised me is that these trends hold true. And there are certain segments of our market that are overbid. There are certain segments of our market that are underbid. And I would say to you that San Francisco is Exhibit A. People headed for the hills from San Francisco because of a lot of the negative political stories and the softness in the office market. I said, hold the line. Because I'm not saying all of San Francisco is coming back. I'm saying these submarkets are going to come back because, number one, San Francisco always comes back. 72 cents of every AI dollar goes there. Infrastructure is incredible there. Wealth, education, all the things that are what I call, this is my key point when I look at investment theses, DDD, durable demand drivers. If there are durable demand drivers, you go there, particularly when people aren't. And so that same horse racing mentality would have made people money if they listened. And by the way, it's still not too late to get into San Fran because we just came out with the office numbers yesterday. And guess what? Our number one rent growth forecast market, San Francisco. There ain't no glory and I told you so, but how you like me now?
Well, I love the perspective and just the experience you have. And I'm going to ask you in a minute about, where you might invest dollars today. I think I know one of the areas that you're going to talk about. But help me understand your own biases that you might have as you provide advice. How do you keep those in check and manage that, recognizing that you always focus on the facts, but you provide your opinion? But we all, to be human, is to have biases. So how do you regulate that as part of your research responsibilities?
Goes to the same answer I give to I gave this morning. I was doing some mentoring this morning. Preparation. I know the client. I know what they buy, what they like to buy, what they don't like to buy. And so, as an example, if you're dealing with a core fund that uses NCREIF as their index, they have a swim lane. I could say, oh, go buy secondary market IOS, industrial outdoor storage. They'd be like, we love you. You're out of here. I can only buy in these percentage buckets. And so what I try to do is say, okay, this is their swim lane. Where within their swim lane can I give them the best advice? Because I could say, go buy, office buildings in Madrid. And like, I'm a US-based fund. What's that got to do with me? So the client. That's how I regulate my own biases, is by knowing that client. So I got a meeting in New York with a foreign investor tomorrow. And I'm studying this investor. What are they buying? Where are they buying it? Which countries? What types of assets? What structures? So that when I can go in there, I can say, well, you did this particular deal here. This one looks similar, if not better, and this is why. Knowing the client is how I regulate my own biases. And yeah, I do have biases. I'm not going to hide it. I have courage in my convictions. I'm not foolish about it. I will tell you when I'm wrong, but knowing the client helps me the most.
And so what kind of the old line, what keeps you up at night at your job at CBRE? I mean, you travel all over. How many countries have you been to in the last 6 months?
Well, I have my 4th European trip coming up in a month. And I was in the Middle East once this year. I was in Mexico once this year. I'm going to Buenos Aires at the end of this year. What keeps me up at night? Well, actually, from a macro perspective, then I'll go to a micro perspective. From a macro perspective, I give a flip answer. My answer is nothing. And the reason is nothing is because I am a big believer in the Fed. Notwithstanding all the negative press that's been about the Fed and Powell and stuff like that, this guy is the rock of Gibraltar of the U.S. and global central banking system. And the fact that he's a little prickly when it comes to data-driven and doing things so that there's stable pricing and full employment, which is his only mandate, I think is a great thing. So from a macro perspective, I think we're in very good hands with him. And now there's some people in the administration I'm fans of too. But nevertheless, I think that's from a macro perspective. No matter how much noise is out there, this is a steady hand. Okay. From a micro perspective, what concerns me, I would say if I'm going to pinpoint one thing that I think is the single biggest risk factor in our industry right now, is that the 10-year Treasury gets to 5% and stays there. Now, sounds like, well, that's not that big a deal because they were at 4.4% now. That's only 60 basis points. Well, I give a lot of presentations, Robert. Most of them go very well. I'll give you one that went really bad, and it was right in your neck of the woods. Did one in Laguna Beach. I gave a speech to a bunch of multifamily investors, and this was in October of 23. I remember like yesterday. Why? It was the day the 10-year almost hit 5%. And I was there talking all rainbows and unicorns about how we have a housing shortage and housing's the place to be, and interest rates will come down. Well, I would have had a warmer audience at a funeral, because at a 5% 10-year in 2023, most of the equity in that room was wiped out. And so because of that, I believe that, notwithstanding the fact I stand by my comment that the market has adjusted to this higher for longer period, it's based on two things. One, it's low fours, it's not five. And second, the short end of the curve is expected to come down a little bit further, so there's some relief there as well. But if we're wrong, inflation rears its ugly head again, that keeps me up at night.
Well, on the other side of that, and that's, I think, a fair concern, the way you frame that. Um, I would be curious to, you talked about the psychology of gambling. So you got five bets you're going to place in, we'll call it investment real estate broadly. Lots of asset classes within, lots of regions within, there's value, there's core, there's opportunity. Where are you making your five bets as you think about the opportunity set as you see it and you advise your clients?
I'll do it first based on market, then I'll do it based on asset type. So first, based on market, there are two basic types of markets I like, and then we can drill down into the submarkets I'm really talking about here. One of them are zones of new manufacturing, and the second are live workplace submarkets in disfavored markets. So I'll start with the second one. What is a live workplace submarket in a disfavored market? How about Soma in San Francisco or Century City in LA? How about the Fulton Market in Chicago? How about Wynwood in Miami? I can give you 100 of them. The point is that you go to where they have terrific fundamentals in a market where the institutional marketplace may be a little thin. And so that way you can get a yield that's higher than you could get in a place where the institutional marketplace is better. The other one is these manufacturing zones. And so these manufacturing zones, this is not a Trump administration thing. This was coming under Biden with the CHIPS Act, with the Inflation Reduction Act. There was already a lot of reshoring or expected reshoring to come. And what you see in these zones is not just the need for manufacturing, you'll see needs for other forms of real estate, including data centers, including industrial office. And you want to build and buy in and around these areas because that's where the jobs are going to be. And here it comes, the punchline. You get these at a yield that's significantly higher than you would get in a dense urban environment, even one of these live workplace submarkets. And if you're going to be in an environment where interest rates and inflation are higher for longer, you might as well take the yield up front. You can get it in many of these markets because I believe that one of the most overpaid for things in our industry is exit liquidity. I think people put too much stock in that to the point where they will drop the cap rate going in by 50 basis points or more simply with the illusion of exit liquidity, because sometimes that exit liquidity ain't there, particularly if there's a market dislocation. Okay, so I've just given you the two market types, right? And we can go through the country and talk about where they exist. But as far as asset types go, I'm a good old-fashioned supply and demand guy. And as a good old-fashioned supply and demand guy, I think one of the best bets in real estate is BTR, built to rent, because built to rent, there's just not enough housing, and we ain't going to have enough housing anytime soon. I mean, decades. It is unsolvable using reasonable means. We can throw all the money you want at this problem. It ain't a money problem. It's a NIMBY problem. People simply will not allow you to go vertical in suburban locations, or it's very difficult to do BTR. It's also difficult to do BTR because it's very politically disfavored. It's disfavored both federally. It's disfavored at the state level too. So it's a great place to be because nobody likes it. And that you go to places that are supply constrained that we need. Okay, so that's one. Another asset class, industrial outdoor storage, okay? And, dare I say it, doggone it, I'm going to say it, manufactured housing. Why did I say both of those? Same reason. Nobody likes them. And when I say nobody, the locals, the same locals are going to keep your multifamily and your BTR out of their community. They will never, and when I say never, I'm pretty firm on never allow you to build another industrial outdoor storage site. They will almost never allow you to build manufacturing, which is precisely the supply constraint you're looking for. And so those are two sub-asset classes I like. But then, here we go. Now I'm going to get thrown off the show, Robert. But I'm the same guy who said he liked retail when nobody liked it and came back. It's our number one investment asset class right now. I'm the same guy who said San Francisco, it's our number one asset class market right now for rent growth. Best office, best submarket. The train has already left the station. Because if we had this call 7, 8 months ago, and I was in your office, Robert, this spring, I probably said that the only buyers of office are high net worth individuals. The institutions aren't coming in. Guess who's coming in? The institutions. It was a screaming buy then. It's still a buy, not quite as screaming, because people realize we overshot. We overshot on the pendulum of the best office and the best submarkets. Maybe this stuff's better. Maybe people will come back, and they are. And so I would give you those as a couple of my ideas. I still love retail, love housing, and I gave you the subsectors that I like the most. I gave you the different submarkets, the different types of markets.
Great content takeaway for our audience. Thank you. Some real pearls there. I'm thinking about cycles versus paradigm shifts. And I'm thinking about when you started in the real estate business, fast forward to today. So as you think about what is kind of, if try and compare and contrast a little bit about Spencer early stage real estate business and what it is today and what that might offer for an investor.
When I started in this business, I worked for a well-known real estate developer in New York, and we were buying old office buildings for less than $100 a foot and hoping we'd convert them into condos at $300 to $400 a foot. Well, many of those are now being sold at $3,000 to $4,000 a foot. And now, recognizing that construction costs have gone to the moon since the mid 90s, I would just say that same type of courage back then could apply today too, because there's plenty of opportunity based upon what was done then. But I think the key takeaway is what I started this conversation with, Robert. We were not in a financialization business back then. We were in an operator business. And for people who have a few gray hairs, and by the way, Robert and I are both 29, but if you have a few gray hairs on your head, you'll remember the real estate business was a bad place to be from 1988 to 2000, because the 1987 Tax Act really put a crimp in our business. And there were a lot of glass towers on Park Avenue, LA, and elsewhere that were built simply for double declining depreciation. And so that went away, and so did the value. And so what does that remind you of? Empty office buildings, late 80s to 2000, bump today. So I think number one, there are some similarities in terms of the asset changes that were in play at that point, which is rhyming with today. But really, it was an operations business, because you went in there. I bet the average cap rate for the average office building in 1995 was 8.5. I mean, I'm just guessing, because I don't know. It's probably about that, right? What is it today? 8.5. I mean, we're in this back to the future, because the 10-year treasury came up. We have this secular shift, and to make money, you need to operate. So I think the lessons I learned there makes today, and I said this on stage, and I'll say it again on this show, Robert, today's a great time to be in real estate, because you know who's going to win? Real estate operators.
I love it. Excellent. I think about the change of the capital markets, the change of the workforce of the real estate service provider, the education that they get, the access to information. All that stuff, I think, has allowed more capital to flow freely and predictably to the asset class. That, to me, is the biggest change. That's not a paradigm shift. It's just an evolution, and capital flows to opportunity. But I like the way you frame that. So I want to be mindful of our time today, and appreciate your very thoughtful contributions. Help us understand the future of Spencer Levy, and how do you look at the next chapter for you as you think about your own career?
Well, I'm very fortunate. I think, as I mentioned, my moment of courage, which changed the trajectory of my career to where I am today. We all have things we love. Putting aside my hobbies of horse racing and really bad golf, though I did play Torrey Pines twice last week, so that was a good day to play bad golf. I love communicating. And when I say communicating, it is in sometimes an academic setting. I'm very fortunate that in the last year, I gave keynote addresses at multiple schools, including my alma mater, Cornell, at University of North Carolina, where I spoke on the floor of the Dean Dome, and I felt like an athlete for about 2 seconds. And then I spoke at University of Indiana, and I can go, the list is endless. I love it. And I would say, one day down the road, when my ship comes in, I would see myself running a big real estate program at a big university and lecturing like this on the side, going to industry events, still working with clients on a consulting basis. So if that, probably 5 years off, 5+ years off, maybe more. But if I were to say a future, that might be it. And you know what? I'm happy now. I'll be happy then.
Yeah. Well, you obviously are an amazing communicator. I would offer to you that you seem to be living your best life because I thought about, do you fancy yourself as a consultant, a researcher, or an economist, entertainer? And I think you use the latter one as your expert communication skills to get the information out and people listen. So the take home value is much greater because they're actually listening to you and enjoying the way you're presenting. So kudos to you and keep doing what you're doing. I know we have a lot of young folks on our show here today that listen in, family members, people thinking about getting into the real estate career. What might you offer as some takeaways to a young person thinking about pursuing a career in real estate where you've spent your entire life?
So first of all, let me just comment on what you said just a moment ago, and then I'm going to go right back to that. So, aren't you entertained? What was that from Gladiator? The entertainment is a tool for what we're trying to do here today. Not inform, persuade. And to persuade, people first need to remember you. So I don't entertain for entertainment value, though I'm happy you're entertained. I entertain so that you retain it. So there's a method to what might be perceived as the madness. Okay. And now to the advice. I haven't given this advice since this morning, and I would encourage people who are listening here to read my LinkedIn feeds because I give this advice weekly in the LinkedIn feeds about exactly what I'm going to say here now. And I say this to young professionals. There's table stakes. There's things that you are expected to have if you're going to be in this business. And the table stakes are to be a rock star at Excel, PowerPoint, real estate analysis. That is table stakes. Most of you can do that, okay? But to get to that next level, the level of excellence, the level of Robert, and I say this, and I hope I'm not, Robert is not just a great thinker, he is a great communicator of his thinking. And that is what we're getting you to. And to get to there, you need to think, well, how am I going to get this message across? And so 5 years ago, when I started our podcast, The Weekly Take, we did it because we didn't know what else to do. It was the middle of COVID. And we said, we got to talk to our clients differently. And it's, knock on wood, has been an enormous success, as has Robert's show. But we also learned how to communicate with LinkedIn. I'm now a big user of that. But I also communicate on stage and I communicate in one-on-one settings. But I'm going to be very simple in the message I'm going to give on communication skills. Communicate in the corporate setting more similarly to how you communicate in the private setting. What does that mean? Keep it real. Emote a little bit. You probably hear me emoting a little bit more. And why? Am I trying to be entertaining? No. Well, maybe a little bit. Entertaining for a purpose. Because persuasion isn't an intellectual process. Persuasion is an emotional process. So when you want to persuade people to invest in your BTR development in San Fernando Valley, is it going to be an intellectual process because you can get to an IRR return that's higher than you can get if you do it in Pasadena? Or is it an emotional one to say, well, there's a 150 basis point delta there. Maybe that's not enough, but since you told me about the new freeway going in there and the fact you had a great meal last night in San Fernando Valley at some great little Mexican joint and you saw all these investors there that you didn't expect, that's a story. I remember that story. I'm now more comfortable. I'm now going to put my money in. So where am I going here? Table stakes, essential. Communication, that's what gets you to the next level. And part of communication isn't just the words out of your mouth and how you express them. And this next point is maybe the more important, preparation. You need to know your audience. You need to know their biases. When Robert asked me about my biases, I know my biases. And I try to overcome them by knowing the audience's biases. And then you can communicate more effectively with that audience. So table stakes, rock star, communication at the same level, you'll succeed.
My gosh. Well, for sure, I'm going to have you back, Spencer, because there's just the content delivery and take-home value of our time together is first class. I had a go-forward moment where I was sitting in a Cornell classroom and Professor Levy was sharing with me in my seat, and I sure hope you have a chance to follow that dream. Your missives today and communication. I mean, the notes I made: psychology of gambling, investment opportunities, communication skills, table stakes, back to the future, operator's business. My gosh, I hope, I'm sure there'll be people that re-listen to this a couple of times and take lots of notes. So I want to thank you. We'll have you back for sure on our Counting Capital podcast. You've been a 10, and I appreciate your time. So thank you.
Well, Robert, thank you for having me. Congratulations on the success of your show. And we, on behalf of CBRE, we appreciate what we do together.
I want to thank everybody for participating today. I know, like myself, you thoroughly enjoyed it, and we're going to look forward to seeing you on our next Counting Capital podcast. Thank you again.
Thank you for joining us on this episode of the Counting Capital podcast. For informational purposes only, and not to be relied on in any manner as legal, business, financial, tax, or investment advice. Nothing in this episode is an offer to sell or the solicitation of an offer to buy securities. To learn more about Buchanan Street Partners, please visit our website at buchananstreet.com. Buchanan Street Partners, capital you can count on.